This analysis examines a firm's business mechanics and financial structure for educational purposes, not as an investment recommendation. Affirm functions as a consumer credit risk arbitrageur, monetizing the gap between what its internal models know about a borrower's default risk and what the broader market assumes. The foundation of that knowledge gap is scale. Affirm's instantaneous underwriting engine executes a soft credit pull, routing applicants through a machine learning model calibrated against 343 million historically processed loans. By utilizing over 500 distinct variables per transaction rather than a static FICO score, Affirm achieves a specific micro-advantage. They approve 20% more consumers than traditional banks at the point of sale. Higher approval rates typically signal higher risk. Here, the opposite occurs. Affirm maintains a 30-day delinquency rate of roughly 2.4%. The baseline for legacy credit cards sits at 9%. Saving several percentage points on credit loss per dollar loaned creates extreme operational leverage. Across tens of billions of dollars in gross merchandise volume, that specific algorithmic efficiency dictates whether the entire enterprise generates a profit or burns capital. At the level of a single checkout transaction, Affirm operates a mathematically superior underwriting engine. The model captures specific risk premiums that traditional lenders structurally miss. The thesis relies on that transaction-level precision scaling into macro-level safety. We have to test if accumulating more data actually eliminates absolute credit risk over time. This chart maps Affirm's net charge-off rate, or NCO. Between fiscal year 2020 and 2025, Affirm multiplied its training data volume nearly 7 times over. Yet the charge-off rate did not trend downward. It oscillated continuously between 6% and 8%. The machine learning model excels at safely approving a wider pool of applicants on the margins. It does not reduce the absolute floor of credit loss dictated by the broader economy. A specific systemic blind spot limits the model's predictive power. The industry calls it loan stacking. Buy now, pay later usage has proliferated. Today, nearly 2/3 of these borrowers carry simultaneous active installment plans across multiple competing providers. Because these alternative credit platforms do not centralize their reporting to traditional credit bureaus in real time, a consumer's total cumulative debt load is invisible to a firm's internal algorithm during that 3-second checkout window. The data Moat accurately filters individual applicants based on known variables. It leaves the firm highly exposed to a systemic macro debt crisis, where consumers simultaneously default across multiple invisible obligations. Remaining an occasional checkout option heavily dependent on large retail partners restricts margin growth. To justify its valuation, Affirm is attempting to migrate from a sporadic financing widget to a daily use payments ecosystem. The mechanism driving this transition is the Affirm card, a Visa debit card allowing users to convert everyday purchases into installment loans directly, independent of merchant integration. In the second quarter of fiscal 2026, the gross merchandise volume flowing specifically through the Affirm card grew 160% year-over-year. To acquire these daily users, Affirm strategically expanded its 0% APR product. The merchant subsidizes the interest via a higher fee, treating it as an alternative to a marketing discount. Affirm uses this zero-interest entry point to capture users, half of whom eventually convert to standard interest-bearing loans. This aggressive expansion forces direct confrontation with PayPal. PayPal processes $40 billion in its own buy now, pay later volume. It deploys this across an existing base of over 430 million active accounts. Because the product is embedded into a network users already navigate, PayPal's customer acquisition cost for installment loans approaches zero. A secondary structural threat sits with incumbent banks. Legacy institutions fund their lending via consumer deposits costing 3 to 4%. Affirm relies on warehouse lines and capital markets that cost hundreds of basis points more. Affirm is in a strict race. They must solidify habitual consumer use of the Affirm card before legacy competitors leverage their vast distribution networks and cheaper capital to commoditize the space entirely. Navigating that competitive gauntlet requires strict executive alignment. Max Levchin built the original architecture, and his control over the firm remains absolute. Through a dual-class share structure, Levchin commands 44.4% of the voting power. His base salary is set at exactly $38,834. He takes zero current bonus and zero ongoing equity grants. This chart tracks stock-based compensation as a percentage of revenue. Affirm systematically compressed this dilution from nearly 34. Looking at this cash flow waterfall for fiscal year 2025, Affirm generated $652 million in free cash flow. They funneled $580 million directly into organic reinvestment, allocating a minimal $18 million toward mergers and acquisitions. There are no expensive vanity acquisitions on the balance sheet. The governance structure protects long-term shareholder value, but the executive team's personal financial behavior points elsewhere. This graph displays 12 months of insider transactions. The massive downward bar reflects Levchin liquidating over $150 million of exposure. Over a 5-year period, there is zero open market conviction buying by the C-suite. No executive purchased shares with their own cash. Investors must trust a multi-year horizon, while management's financial actions execute a rapid reduction of their personal risk. Looking at this comparables table, Affirm trades at roughly 24.8 times forward earnings, with a negative 2.7% EBIT margin. A 24% internal rate of return at these multiples requires 100% of that return to come from operational earnings execution. The model assumes zero multiple expansion. To maintain that rate of return while the valuation multiple remains flat, Affirm must drastically increase its earnings through operating leverage. This specific growth math dictates that the current negative 2.7% EBIT margin must climb to 35% within 5 years to satisfy the current stock price. At these prices, investors wager strictly on historic operational leverage and successfully executing those aggressive margin targets. The market supports this premium because the recent financial data confirms a significant operational pivot. This chart maps GAAP earnings per share. The metric jumped from a single penny to 37 cents in just 3 quarters. A 37x acceleration proves that the operational leverage discussed earlier is a hard financial fact, not a theoretical projection. The upcoming May 2026 earnings report serves as the immediate testing ground. Affirm must prove it can sustain adjusted operating margins above its 27.1% guidance floor. But a fat tail risk currently sits completely outside of management's operational control. Donald Trump proposed a federal cap on credit card interest rates. If enacted, policies will heavily scrutinize the broader consumer credit sector, including installment lenders. This risk matrix isolates the severity of that specific political catalyst. Affirm is uniquely vulnerable to a rate cap compared to its direct peers. Competitors like Klarna extract the majority of their revenue from merchant discount fees. Affirm depends on direct consumer interest income for roughly 45% of its total revenue. A blanket federal rate cap would structurally devastate Affirm's margins overnight. Affirm is scaling a 160% growth product on top of a $343 million loan data moat, executing a highly profitable transition toward daily payments. Yet, they walk a razor-thin tightrope, balancing verified operational leverage against systemic credit blind spots and uncontrollable political traps.